North American markets, a bit of selling today, but they are essentially at all-time highs. Our guest says that growth momentum is slowing, but there's increased focus on what he calls quality growth. We are joined by Belski, Chief Investment Strategist at BMO Capital Markets. Great to see you.
Andrew, thank you. Good morning, Canada. What a beautiful day. It's always great to start off the September period here, the first day of September, back to work in Toronto.
And the weather's often beautiful.
Oh my gosh, it's absolutely gorgeous. So I'm blessed to be here. Thank you so much for having us.
Growth momentum, as you say, is slowing. What does that mean?
Well, remember, a lot of analysts have been revising their numbers higher, Andrew, because they revised them so lower in the beginning of the year. So it's a bit of catch-up. When we knew with some fundamental certainty that the tariffs were not going to, quote-unquote, crash companies. And I think analysts at the beginning of the year, it showed up in our models that analysts were dropping their numbers too much. And now we've seen a complete reversal of that. But we've said for the last 2 years that Canada was going to outperform. We've been in print on that, and it continues on a net basis to outperform. But what we view is that we've come off the lows in terms of where we have been with respect to earnings growth rates. Now you focus on quality, not just earnings. If you take a look at the performance of the TSX in general, it's about the last 12 months of earnings and the next 12 months of earnings. Investors have been seeking those companies that are showing the strongest numbers, Andrew. Mm-hmm. So I think once we've seen that trend, our work and our exhaustive back testing and historical work over doing this for 36 years shows that you want to transition into higher quality. What's higher quality? The operating performance of companies. Now, this takes stock picking. It takes more inherent analysis when you're looking at return on equity, free cash flow yields, return on assets. Once you start to see those particular metrics begin to improve, you can add those to earnings. I'm not saying don't buy companies that are showing earnings growth, but you can actually have that as a buffer and an additive to those companies that potentially could be slowing in earnings.
Right. So you're looking for consistency, among other things?
Correct. A hallmark to our call, remember, we've had a call on the U.S. stock market that's been in a 25-year secular bull market that started in 2010. And we've been in print on that. But a hallmark to our call and why we've been so bullish on the U.S. is this notion of earnings consistency, meaning we're not seeing variability of earnings, just very consistent earnings growth. And oh, by the way, guess what? Did you see that earnings growth chart for Canada? It's becoming more consistent, isn't it?
Let's put that chart. Okay, let's go back to the first chart. Sorry, controller room.
So you see that?
Okay.
So look at over the last 10 years. I believe that we're heading back into this period of the mid-2000s when we first came to BMO in 2012. We had this amazing period of earnings consistency in terms of the growth rate. For Canada, this is the TSX. I believe we're heading back into that 10 to 15% earnings growth, which is amazing with respect to, if you take a look at Canada as what we believe is a more value cyclical market relative to the U.S. We think there's still amazing stock picking opportunities in Canada. But then when you dovetail that, Andrew, and we did a lot of the dovetailing and added this quality growth and overall quality investment theme in those 2012 to current basis. That's how we've been able to massively outperform in the portfolios that we have such a great honor and pleasure of running for BMO Private Wealth.
Let's turn to the U.S. market. Now, we have a chart. I think it goes through August 21st, so it's a little old, but
nothing's happened. I mean, everyone's been on vacation.
That's
quite
everyone's
true. Back to work now.
That's quite true. Isn't that interesting? So these are S&P 500 stocks that were few and far between beating the index in 23, 24. Yep. There were few and far between, but quite a few are beating the index this year.
You know, Andrew, this is an important chart because nobody believes it. And why nobody believes is I think that it's a microcosm of what happened during COVID, and before that, all we do is kind of bullet point analysis and direct message, and we see the first thing, Magnificent Seven and the big cap tech stocks have to be outperforming. But this is a pretty amazing chart, and it actually shows that the majority of companies, more and more companies outperforming. That means you're seeing a broadening out of the stock market. That means it's inherent about stock picking. That means we're returning to fundamentals and not just momentum and buying high liquidity names.
That's fascinating. So the Mag 7, we've seen a lot of those big names come off their highs. They're not rolling over.
Yep.
But that's interesting. So there hasn't been this hidden bear market out there by that measure.
No,
anyway.
not at all. And again, we have the very great fortune of sub-advising 10 equity portfolios for our wealth management platform at BMO, and the majority are outperforming. All of them are outperforming this year. And I think the reason for that is, in the last 12 months, I'm sorry, for sure. And the reason for that is, especially the U.S. ones, is because of this, we are not overweight the Magnificent Seven. We picked and chosen which tech stocks and which communication services stocks and which consumer discretionary stocks we might have been. And so over the last 12 months, all of our U.S.-centric and U.S. mixed portfolios have been outperforming because we've actually been in the right names, and that's about stock picking.
Is there any stocks that in the Canadian market that jump out for you in this terms of this quality growth, or any sectors, Brian?
Well, I think if you take a look at industrials as an area, Tormont is a name.
Okay.
Tormont's a name that we've owned in our
TIH.
Yeah,
okay.
is a name that we've owned for a long time in a portfolio we call anything but the big three. It's any stock in Canada that's not in energy, not financial, and not material. Mm-hmm. Great company. And now this is another company, by the way, that dovetails well into consistent earnings and quality with respect to return on equity and return on assets. And this is what those two attributes in terms of return on equity and return on assets are two metrics that people don't talk about enough, but it's kept us in this stock for several years.
That's interesting. Maybe you could put up a 5-year chart for Toromont, a heavy equipment dealer, if I remember rightly.
Yes.
Yeah.
Yes. And again, I think so many people in Canada really focus on the rails as a big industrial side of things,
Sure.
or Air Canada. And so, while those companies are obviously amazing, Toromont has been I believe, a picture of consistency with respect of its fundamental attributes.
Can you talk to us at all about TD Bank? It's a rival bank, or would you rather
No.
hold off?
I mean, TD we've owned for several years, and in fact, we increased our position pretty substantially last year in all of our Canadian-centric and Canadian mixed portfolios, principally because we think people got way too negative. And remember, too, about a year and a half ago, we put out a report talking about the historical performance of Canadian banks following this massive amount of over-reserving. A lot of Canadian banks put a lot of money aside for loan loss reserves, thinking that Canada was going into recession and things. And TD was one of them that over-reserved, we believe, and has benefited from now putting that cash to work through increasing their dividends, buybacks, and the like. So we're very, very humbled to say that we were early in the TD liking it over a year ago, and we still like the bank from a longer-term basis. Canadian banks, in our perspective, are amazing stewards of capital. Amazing stewards of capital with respect to how they buy back stock, how they continue to pay dividends.
Brian, thank you very much, as ever.
Thank you so much.
Brian Belski, Chief Investment Strategist, at BMO Capital Markets.